Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update for Friday, June 16th. In today's strategy update, I'm going to review the three elements that a few months ago we indicated would be important to see progress on if the market that started to uptrend off of the low last October was going to continue over a more durable bull cycle. And what we indicated back then was that, number one, we want to see the market break out of key resistance levels. And for the S&P, that was 4,200, which has now occurred. S&P is broken not only through 4,200, but up to 4,400. The MSCI All Country World Index, a little bit different number at 660, that also has occurred. So we've seen these major market indices break out of their resistance levels. They're still 9 to 10% off of their all-time highs, but they have been able to penetrate now in the last couple of weeks levels that have been challenging to get through on the way back up. And that's an encouraging sign. The second area we wanted to see improvement in was the breadth, or the participation in the market, the number of stocks and asset classes moving up with the market. And while we have seen some improvement in the last 2 weeks in that area, a little bit better participation, we still think that we need to see some progress there. There's a fairly narrow group of stocks that have really dominated the market movement in the indices this year. And, when we look at that, we also see that most of the market, the price action in these stocks that have been the big movers, the Apples and Microsofts and Teslas and Nvidias, etc. Most of that has come from not because earnings are increasing or earnings estimates are increasing, but because the price of the stocks have gone up and they're trading at higher valuations than they were at the beginning of the year. So we're going to look at a chart in a few minutes, actually, that will really, I think, open your eyes into just exactly what the dynamics are behind this year's upward trend in the market, at least so far in the first half of the year. The third area that we wanted to see improvement in was the economic headwinds. And as John reported in our last update, we're not seeing any progress there at this point. So it's going to take a while to see any economic progress, we believe. And that continues to be a problem area. Without a strong economy, it's difficult to see broad earnings strength, across the economy. We may see it in some select areas, but not in the cyclical areas that are dependent on economic growth. So when we look at those three elements, we have one of the three. We could check off that box. The breadth, gaining a little bit of strength, but we don't really think we could check that box off just yet. And from an economic standpoint, we certainly can't check that one off yet. All the leading indications continue to point lower, and we would expect at some point we'll have some sort of recession in the economy. Let's take a quick look at our proactive asset allocation dashboard. And we could see all the arrows continue to point up as they have been since the global buy signal November 30th last year. The significant change is over here in the cash comparison chart. You might recall that had been negative for a period of time, and it now has flipped back into positive territory. So let's take a quick look at the cash comparison charts. And as you may recall, we run two different versions of these charts. One is called a relative strength chart and the other a rate of change chart. And it's particularly in the rate of change chart that we've seen the improvement that caused the status to change. If we look at the latest action in the chart, it has been moving to the upside. It's now broken above the February high and last August high. You can see from the all-time high in the market, there were a series of lower X columns and lower O columns. We now have the first higher X column. So that is a mechanical improvement in this type of chart. Now, like with any breakout, we want to see follow through in that direction. So it's important to see this continue to rise. If it's unable to, a quick reversal down actually, takes a small positive and turns it into a negative. So we'll continue to monitor progress in this area. The relative strength chart has not broken out yet. It would have to get above. It only has one hurdle to jump over, and that's last August high. And some further improvement could see that chart also move to that mechanical buy signal. So by looking at this, you could see stocks are breaking out. This is a market index, the MSCI All Country World Index that we're recording relative to the cash returns. And that's a good indication that we're seeing some better performance out of stocks relative to cash over the last, say, 6 months or so. The long-term momentum indicator has been positive for a bit now, as John reported. Universe trend indicator still neutral. We've seen some minor improvement in the numbers there, but not enough to flip that status to positive. So we certainly would like to see that develop if this market trend continues to strengthen and the early signs that some better participation is developing. If that continues, of course, we would expect to see the universe trend indicator move back to a positive status as well. The tactical indicators are beginning to get a little interesting. The 10-week chart is still very neutral at 60%. However, the overbought, oversold indicator is now getting very close to reaching what we consider an overbought level. Let's take a look. So here's our overbought, oversold indicator, and we could see the channel that we've been reviewing since the beginning of this bull cycle, or really campaign, as noted by the date of our global buy signal, where the MSCI All Country World Index was relative to the channel was in the lower end of the channel. And for most of this period, we've been seeing action right through the middle of the channel, and really for a couple of months, very tight movements above and below the bull trend average, and that's the blue line running through the middle of the channel. Well, here's where you could see the breakout, right? So the market index has certainly broken above this resistance level, and even if we take this back to some earlier times at last year, that same 660 level was a very strong resistance level. Well, that certainly has broken through. Now we're beginning to move to the upper end of the channel. And when we get to this red zone, statistically it's an overbought market condition, meaning that when we look at all of the other periods that our model was on a buy signal, that's beginning to get to, say, a standard deviation above the bull trend average when we get up into the red zone. We're not quite there yet, but certainly we're getting very close. Stocks are about 4.5% or so above the bull trend average. We tend not to get much higher than that before some pullbacks or consolidations occur. So we'll be on the lookout for any further upside movement, probably not lasting without some sort of pullback in the market that we think would follow throughout the summertime. And when we look at the MSCI All Country World Index, it's a global market index. Of course, the U.S. market is the largest weighting in the global market index. And taking one step further, the mega cap U.S. stocks are really controlling this index, not as much as they control, say, the S&P 500 or the NASDAQ, because there is some foreign influence in this as well, but still have a significant weighting in the global stock index. So when those mega cap stocks make a move the way that they've had in the last, say, few months, that has a big influence on this index as well. So I just want you to keep that in mind when we look at some charts on those mega cap stocks in a couple of minutes relative to their earnings growth, and really see the dynamics of what is moving the stock market, both here in the U.S. and globally at this point. Now, you would think the global stock index, which is really a summary of all of the industry groups and all of the foreign markets, when we rank that asset class relative to all the other asset classes, typically it's very much in the middle of the pack. Well, today we see it ranked as about as high as it's ever been ranked throughout the history of our database, which goes back to about 1995. Now, what's the importance of that? Well, what we're looking at is a ranking system here of all of the asset classes, and there's 104 asset classes in this ranking system. So typically you see the global stock index somewhere in the middle, say in the 50 range. Maybe it gets a little bit higher on occasion, maybe it goes a little bit lower on occasion, but generally it's right around that mid-range. Well, today we see it ranked up at 30. These are two different ranking methodologies, so I'm using this first one for this representation. And what that tells us is that the global stock index really is quite strong relative to other asset classes. In other words, there aren't a lot of industry groups or country markets that are outperforming just that very broad global stock index. And since that global stock index is still heavily weighted in the U.S., and the U.S. is heavily weighted in those handful of mega cap growth companies, that's what's pushing this index up in strength relative to many other asset classes. So it's a pretty rare situation to see the global stock index ranked this high in a relative ranking. We've talked often this year about how narrow the market's movement has been in participation and how these mega cap growth stocks are really driving the index. But I think this chart really drives that story home. And this is a couple of weeks old, and we have seen a little bit better participation, as I've been saying, in the market, but I think it still is very good representation of the dynamics that are moving the market, the S&P, and what's happening in those mega cap stocks relative to all the others. So when we have those seven, Meta, Amazon, Apple, Microsoft, Google, Tesla, NVIDIA, and so on, they're up 53% as a group this year. And those are the largest weighted stocks in the S&P 500 for the most part. That's causing the S&P 500 to be up in that 11% range. Again, this is going back a couple of weeks ago, so we've seen a little bit more push higher. But the other 493 stocks as of June 1st hadn't made any progress. So what we have is really those seven stocks causing all of the improvement in the market index as measured by the S&P 500. And as I've said earlier, we're seeing that influence carry into the global stock arena as well, because these are still the largest companies in the world and the most heavily weighted in those global stock indices. Let's take a look at a few of these stocks individually and not put together as one package. And we could see all of the stocks are up. NVIDIA, by far the strongest. But we have 100% moves in a couple of them. Tesla, Meta, NVIDIA. The worst performers up 40%. And that's Alphabet or Google. Now you would think with stock performance being up this much, and this is just a year-to-date movement, so less than 6 months, that fundamentals should be improving significantly in these stocks or companies. Right? Earnings estimates should be going up significantly. Why would these stocks be going up if their fundamentals aren't improving? But we find that that's not the case. We're finding that stock prices are up. So looking at Apple, of course the biggest company by market capitalization, up 42% this year. Its earnings per share estimate for the current fiscal year from the beginning of the year to today is actually down 3%. So earnings estimates are lower today than where they were at the beginning of the year. Yet investors have bid up the price of the stock by 42%. What that means is investors are willing to pay 42% more today than they were at the beginning of the year, but for less fundamentals and less earnings. So all of this movement is driven by the price to earnings ratio moving up. So you could see The PE ratio has moved up 42%, and the stock has moved up 42%. It's not being pushed higher by better expected earnings. And we see that throughout all of these stocks. We won't look at every single one, but let's take a look at Microsoft. Right? Microsoft stock is up 43%. All of it because their price to earnings ratio has increased 43%. Earnings estimates are only up 1% from where they were at the beginning of the year to where they are today. So why am I showing you that? Well, that's a pretty significant concern. This isn't a fundamental improvement driven bull market. This is a valuation increase driven bull market. Investors are pouring money into a very narrow group of the largest stocks out there. And it's not because as a group their earnings estimates are improving. It's because they're just willing to pay much higher prices today than they were at the beginning of the year. So you'd have to ask yourself, is that really a good approach to investing, to buy stocks that are kind of expensive at the beginning of the year? I would say certainly not as expensive as they were at their all-time highs going back a year or so prior, but still from historical measures, highly valued stocks. But now they're going to even higher valuations without fundamental improvement. Probably not the way we want to see a new bull market start. And because of that and some other items that we look at, areas that we look at, we don't really think that this is the beginning of a major multi-year bull trend. But it's probably something that's cyclical, certainly have some strength behind it right now with indices hitting new 12-month highs, not all-time highs, but annual highs. And this momentum could continue to push stocks higher for a while. But we don't think that this is likely to develop into a multi-year bull cycle because fundamentals just are not improving along with stock prices. Well, that's going to wrap up this strategy update. I want to wish all your dads out there happy Father's Day. I hope you enjoy your holiday weekend. Take care.